Are you driving to work, heading to the gym, or maybe just taking a short break from revision? Perfect. Because in this deep dive, we're going to make sense of how management accountants approach short-term decisions. This is really a crucial area of performance management. It fundamentally tests your logic, your conceptual framework, much more than it tests your calculator skills. We're aiming to cut through some of the complexity in the source material that deals with these short-term choices. And our mission today, well, it's pretty simple, really. We want to give you that intuitive framework so you know why the numbers move the way they do. We want you to be able to spot the relevant cause, well, almost instantly, and understand the real economic impact of every choice.
Absolutely. This really is the bedrock, isn't it? It's foundational for so many marginal costing decisions within performance management. Honestly, without a firm grasp here, things like transfer pricing or even linear programming, they just become unnecessarily complicated later on. So what we'll do is take those sometimes complex rules of relevant costing, which, let's face it, can feel like a dizzying list of exceptions, and distill them down. We want to get to clear, actionable intuition. Think of it like a conceptual checklist that can genuinely improve your decision-making instincts straight away.
That sounds like exactly what's needed, a vital mission indeed. Okay, so let's maybe establish the playing field first. When we talk about short-term decisions in this professional context, what are we actually dealing with? What's the scope here?
Right. Good question. We are primarily looking at choices, where the time horizon is, well, extremely limited. Usually we define that as just one accounting period. The main goal is simply maximizing results for that next immediate period. We're not, focusing on those big strategic decade-long investments or major capital expenditure. We're looking at operational choices. Things like, should we accept this one-off special order? Should we perhaps shut down this particular product line? Should we make this component ourselves or just buy it in? Those kinds of things.
Okay, so we're operating in a pretty constrained environment then. That must mean we have to make some assumptions, right, to simplify the analysis.
Absolutely. We definitely need to clarify the constraints and the assumptions that are implicit in the short-term model.
Yeah.
And probably the biggest one relates to fixed costs. This is often where people coming over from, say, financial accounting can hit a bit of a wall.
Sure.
Because in the short run, many costs, just by definition, they remain constant, regardless of the immediate decision we make.
Like the factory rent, perhaps? If I decide to take on a special order this week, my rent payment next month, well, it doesn't change, does it?
Precisely. That's a perfect example. That factory rent, or maybe the head office security costs, or even the production supervisor's fixed annual salary, those are often committed costs. Whether you produce, say, 100 units or 10,000 units in that short period, those costs generally remain payable. So for the purpose of choosing between option A and option B, they become irrelevant. Why? Because they don't actually change the outcome. The focus shifts entirely, you see. It shifts to identifying which revenues and, crucially, which costs will change as a direct result of the decision you're considering.
Ah, okay. And this is why the whole discussion really pivots around one single concept that's, well, much more useful than profit in the short term, and that's contribution.
Contribution. Yes, that's the fundamental metric here. It's really the engine driving short-term analysis. We define contribution per unit quite simply. Selling price minus all variable costs. Now, why is it so important? Well, because, as we said, fixed costs stay fixed. They're generally unavoidable in the short term. So the only element that allows us to cover those fixed costs and then hopefully eventually generate a profit is the contribution generated by each unit sold. Maximizing the total contribution, therefore, is functionally the same as maximizing short-term profit. It's the key driver.
Right. So if we know we're focused on the immediate future, we're ignoring those non-changing fixed costs and we're using contribution as our main yardstick. Well, we arrive at the golden rule of this whole topic, don't we? Only relevant costs matter.
That's the rule. That's the one you really have to internalize. And we need a pretty rigorous definition for it, too. A relevant cost is simply one that is relevant to the specific decision being made right now. And it has three key characteristics. First, it must be a future cost. It can't be something from the past. Second, it must involve an actual cash flow, or importantly, an opportunity cost. We'll get into that. And third, critically, it must differ between the alternatives you're considering. If a cost would be exactly the same whether you choose option A or option B, it gives you no information for the decision, so you ignore it.
That definitely seems counterintuitive at first glance, doesn't it? Especially for people used to traditional accounting ledgers, which, meticulously track every single dollar spent.
Yeah.
It forces you to actively discard information you already have.
It does. It feels unnatural sometimes. And the biggest category of costs you must immediately learn to discard are what we call sunk costs.
Sunk costs.
Right.
They represent the past. But let's pin down a clear definition. What exactly are they?
Okay? Sunk costs are costs that have already been incurred. They are historical. They represent money that's already been spent or commitments already made. By their very definition, they cannot be retrieved or changed by any decision you make now or in the future. Think of it this way. They are costs that will remain payable regardless of the outcome of the decision you're currently facing.
Let's maybe use a highly relatable analogy, perhaps that classic gym membership one that often comes up. Imagine you paid, say, $600 for an annual gym membership 6 months ago. Done deal. Now it's, I don't know, a rainy Tuesday morning, and you're deciding whether to actually drag yourself to the gym or just stay home and watch a movie.
Right. That $600 you spent 6 months ago, that's a sunk cost. It's already paid. It's gone. Whether you decide to go to the gym 5 times this week or 0 times, that $600 isn't coming back. Therefore, when making the short-term decision today, gym or couch, that $600 payment is completely irrelevant. The only things that actually matter for this decision are the incremental costs, maybe the gas money you get there, perhaps a locker fee, versus the incremental benefits, fitness, stress relief, whatever they might be for you.
It's irrelevant because the financial consequence of that historical decision, buying the membership, has already happened. The money is gone. Can't change it.
Exactly. Now, let's try and apply this same logic to a more complex management scenario. Let's draw from that special order example in the source material, example 2, specifically looking at the raw materials aspect. This one needs a bit more thought, as it brings in replacement cost versus opportunity cost.
Okay, walk us through this specific scenario then. What's the setup?
Right, so the situation is we have a stock of material. It was bought quite some time ago, maybe for a different product line that's now discontinued. And the historical cost, what we actually paid for it back then, was $34,000. Now, straight away, that $34,000 sunk cost. It's paid, it's gone, we ignored for the decision. Forget the $34,000. The company is now considering a special one-off order that happens to require 7,500 kilograms of this specific material that's just sitting there in inventory.
Okay, so the immediate question is, what is the relevant cost of using this material now for this potential order?
Well, it depends entirely on what the alternative use for that material is. What else could we do with it? The source material notes that this particular inventory isn't used for any current products, and it's unlikely to be needed in the future, except that the entire stock could be sold off today as scrap for $4.20 per kilogram.
Ah, okay, so now we have potentially 3 different cost figures floating around. There's the $34,000 historical cost, which we've already established is irrelevant, sunk. Then there's the current replacement cost, what it would cost to buy new material today. But that's also irrelevant here, right? Because we wouldn't replace a material we don't actually need for anything else. And then there's this potential sale value, the scrap value.
Exactly. And this is where that crucial forward-looking management accounting mindset really kicks in. If we decide to use the 7,500 kilograms for this special order, what are we giving up? We are sacrificing the opportunity to sell this exact 7,500 kilograms right now at $4.20 per kilograms. That lost income, which works out to $31,500, 7,500 kilograms, $4.20 kilograms, that is the opportunity cost of using the material internally for the special order.
Okay, hold on. If we use the material, we're incurring a cost of $31,500, even though no actual cash leaves the bank right now related to that $31,500. How do we explain treating lost potential revenue as a cost? That can feel a bit weird.
It can feel weird, but it's the critical conceptual insight here. We have to assess the net difference to the company between choosing the special order versus choosing the next best alternative. In this case, the next best alternative is selling the material for scrap for $31,500 cash. So if we accept the order and use the material, the company's overall financial position is $31,500 worse off compared to if we had just rejected the order and taken the cash in the scrap sale. Therefore, to make the two options comparable, we must treat that $31,500 of lost scrap income as a relevant economic cost of accepting the special order. It's the future consequence of the action, you see.
Right, that distinction of the future consequence versus the historical outlay, that seems to be the absolute core challenge here. It forces management accountants to completely discard that historical cost obsession we see in financial reporting.
And that transition in thinking is, well, it's mandatory for good decision-making. Relevant costs must be future costs that change the outcome depending on the decision. This ensures that managers make decisions based purely on the marginal economic impact, ignoring all the noise from past transactions. If you don't adopt this forward-looking perspective, You really risk accepting unprofitable contracts or maybe even rejecting profitable ones just because the decision gets distorted by irrelevant historical figures that shouldn't even be part of the calculation.
Okay, that makes sense. Let's maybe unpack some more of the specific vocabulary that drives these decisions. We need to clearly distinguish between costs that are kind of extra because of a decision and costs that can perhaps be saved. Let's start with incremental costs.
Right. Incremental costs are probably the easiest category of relevant costs to identify. They are simply the extra or the additional costs that are incurred as a direct consequence of making a particular decision. For instance, if taking on a new special order means we absolutely have to hire some temporary staff for 3 days, or maybe purchase a specialized tool that we wouldn't otherwise need, those specific cash outflows are incremental. They wouldn't exist without the decision to take the order, so they're always relevant to that decision. And their relevance is tied directly to the decision itself. They are the marginal input, the extra bit. Okay, now let's look at the flip side, which is about relevant savings, or what we call avoidable fixed costs. Okay, avoidable fixed costs, sometimes you'll hear them called discretionary fixed costs. These are fixed costs, yes, but they are specifically tied to a particular activity or a sector or maybe a product line. And the key thing is, they would be immediately eliminated or avoided if that specific activity stopped.
This distinction must be really practical, especially when we get to thinking about shutdown problems. We can't just assume that if we close down a whole division, we magically save every single cost that was previously associated with it on paper.
No, absolutely not,
Yeah.
because many fixed costs are what we call non-avoidable or committed. Think about those general costs allocated down from head office, like central IT support or the CEO's salary, or maybe the lease on a building that houses multiple departments. If we decide to close down just one specific product line within that building, those head office costs, they usually remain payable. They just get reapportioned across the remaining product lines. Therefore, those costs are irrelevant to the shutdown decision for that one line. We only factor in the fixed costs that we can truly, genuinely save. For example, maybe the salary of a supervisor who worked only on that product line and would now be made redundant. Or perhaps a specialized insurance policy just for that line that would be canceled. The rule is, if you can't save it by stopping the activity, it's irrelevant because the cost will be the same regardless of whether you shut down or continue.
That's a really powerful conceptual filter. Okay. But we still have probably the trickiest one left, opportunity cost. We touched on it just now with the scrap material example, but let's try and provide a more comprehensive definition.
Opportunity cost. Yes, this is perhaps the most conceptual, but also one of the most essential elements in all of short-term decision-making. Defined simply, it is the value of the benefit that is sacrificed or given up by choosing one course of action in preference to the next best alternative course of action. It's basically the profit we forego by making a particular choice. And it's highly relevant because it represents a real economic loss to the firm, even if it isn't an explicit cash outflow showing up on an invoice.
Right. It's like the hidden price tag of making a choice. If you choose to spend your evening studying for an exam instead of working an extra shift at your part-time job, the lost wages from that shift. That's the opportunity cost of studying. Let's try and translate this into a core business anecdote, perhaps like the one suggested in the source material about introducing a new product.
Okay, yeah, good example. Imagine a company is analyzing whether it should launch a brand new product, let's call it Product C. On paper, the direct manufacturing costs for Product C look quite favorable. It seems profitable in isolation. But the marketing team projects that launching Product C will actually cannibalize some of the sales of Product A, which is an existing, very successful product that generates really high margins for the company.
Okay, so if launching this new product C causes sales of the existing product A to fall by, let's say, $50,000 in revenue, and we know the contribution margin on product A is, say, 40%, then the company effectively loses $20,000 in contribution from product A, right? 40% of $50,000.
Exactly. That lost contribution of $20,000 from Product A is the opportunity cost of launching Product C. So when evaluating whether Product C is a good idea, it must generate enough contribution not only to cover its own incremental production and selling costs, but also it has to be profitable enough to replace that lost $20,000 contribution from Product A. If Product C only generates, say, $15,000 in new contribution itself, then even though it looks profitable on its own P&L, the company as a whole is actually worse off by $5,000 overall. $15K gain, $20K loss.
Wow, yeah. That really reinforces the need to think holistically across the entire business, doesn't it? Not just within departmental silos. And you mentioned opportunity costs arise most acutely when our resources are scarce, which links back to that special order example again.
Yes, exactly. Limited resources are the classic birthplace of opportunity cost. When a resource is constrained, maybe we only have a certain number of machine hours available, or a limited pool of skilled labor, or a fixed amount of a crucial material. Using that resource for Project X automatically means we might be displacing Project Y. If Project Y was our next best use of that scarce resource, then the lost contribution we would have earned from Project Y must be factored in as an opportunity cost when evaluating Project X.
Okay, let's quickly revisit the machine time note in that example 2, the parser LTD contract. It needed 2,000 hours of machine time, and the note said this machine time would otherwise have been used for an existing, highly profitable production run that normally generates a contribution margin of $2 per hour.
Right. So in that case, by allocating those 2,000 hours to the special order, we are directly displacing $4,000 worth of profit that we would have made otherwise. $2 per hour times 2,000 hours. That $4,000 is therefore a relevant opportunity cost of taking the special order. If that special order, after considering all its other relevant costs, materials, incremental labor, etc., generated less than $4,000 in contribution itself, we actually shouldn't take the order. Why? Because the next best alternative use of those machine hours, making the existing product, was financially superior.
Okay, so just to quickly summarize the building blocks we've put in place, we're looking at short-term choices. Fixed costs, usually irrelevant unless they're avoidable. Sunk costs from the past, definitely ignore them. We calculate the incremental cash flows, the extra costs and extra revenues. We look carefully for any avoidable fixed cost savings if we stop something. And crucially, we always have to factor in opportunity costs, the profit or benefit we sacrifice by making one choice over another.
That's a great summary. We've got the conceptual tools now. So let's transition into showing how these concepts kind of mesh together in 3 classic decision scenarios that you'll frequently see tested in performance management exams. This is where the logic really comes alive and gets, well, quite dynamic.
Okay, sounds good. Let's start with shutdown decisions. This is a scenario that often produces a result that feels highly counterintuitive, like deciding to keep a division open even when it's officially reporting a loss. The core question is, should we close a specific product line or department, or should we continue operating it?
Right. And the absolute key here is to immediately ignore the traditional income statement format, because that format, as we know, includes allocations of non-avoidable fixed costs, which just muddy the waters for decision-making. The only decision rule you need here is this. A department should only be shut down if the total contribution lost from stopping its sales is less than the total avoidable fixed costs saved by shutting it down. If the contribution you'd lose is actually greater than the fixed costs you'd save, then shutting it down makes the overall company worse off financially.
Okay, let's use the Rook's product line from example 1 in the source material to walk through the numbers slowly and just focus on the concept. Rook's looks like a losing proposition on paper, doesn't it?
That's right. If you just look at the standard profit and loss statement provided, Rook's generates $40,000 in sales revenue. It has $25,000 in variable costs. That leaves a contribution of $15,000. So far, so good. But it's then allocated $18,000 in fixed costs, which results in it showing an accounting loss of $3,000. Now, any manager relying solely on that P&L statement would probably say, cut the loss, shut down Rook's immediately.
And yet, if we actually investigate shutting Rook's down, we discover something important. Only $5,000 of that $18,000 in fixed costs are actually direct and avoidable, things specific to Rook's. The remaining $13,000, those are allocated general fixed costs, head office stuff. Maybe that will simply get spread across the other remaining product lines, pawns and bishops. They don't disappear.
Exactly. So let's carefully look at the actual financial consequences on the shutdown decision itself. Step 1. If we shut Rook's down, the company immediately loses $15,000 in contribution that was coming in from Rook's sales. That's clearly a negative financial impact. Step 2. If we shut Rook's down, the company immediately saves $5,000 in avoidable fixed costs. Maybe that specific supervisor's salary, for example. That's a positive financial impact, a saving.
Okay, so we lose $15,000 of incoming contribution, but we gain $5,000 back in cost savings. Net effect. That's a deterioration of $10,000 for the company overall. $15K loss, $5K gain equals $10K net loss.
Correct. That $15,000 contribution Rook's was generating, it was successfully covering its own avoidable fixed costs, $5,000, and it was providing an additional $10,000 buffer towards covering those unavoidable allocated $13,000 fixed costs. By eliminating the product line, we simply eliminate that $10,000 contribution buffer. The $13,000 in unavoidable fixed costs, they still have to be covered, but now pawns and bishops have to pick up the entire slack. the company's $10,000 worse off.
That still seems slightly insane to keep a division that's showing a loss on the books. Can you just quickly re-explain why maximizing that contribution is more important here than eliminating the allocated fixed cost burden on paper?
Sure, because the ultimate goal from a short-term decision perspective is to maximize the total cash flow that remains after paying the variable costs. That's the total contribution. That $15,000 in contribution from Rooks is cash, or equivalent, that flows into the business from sales, less only the costs directly related to generating those sales. And crucially, that $15,000 inflow is $10,000 more than the $5,000 in cash savings you would achieve by cutting the line. If you shut Rooks down, you lose the $15,000 inflow, but only gain $5,000 back in outflow savings. Net result, you are $10,000 worse off in terms of cash generation. Therefore, the rule holds. You must maintain any activity that generates a positive contribution greater than its specific avoidable fixed costs.
So the standard P&L statement in this decision-making context is almost like a lie, isn't it? It's perhaps designed for external shareholders using absorption costing, not for effective internal management decision-making using marginal costing principles.
Precisely. It mixes relevant and irrelevant information. Now, as the source materials often suggest, there's sometimes a secondary complexity to consider. What if the resources, the machines, the labor, the factory space that are released by shutting down Rooks could immediately be used for a brand new, potentially highly profitable product, let's call it crowners? This suddenly turns the shutdown decision into an opportunity cost decision as well.
Ah, right. So if Rooks goes, we already know we suffer that $10,000 net financial penalty, the deterioration we calculated. But if those freed up resources can be instantly redeployed to produce these new crowners, and let's say crowners are projected to generate a net economic gain, contribution minus their own avoidable fixed costs of $14,000, well, now we have to compare the sacrifice to the reward, don't we?
Exactly. We compare the two options. Stick with Rooks, which is contributing $10K net, or switch to crowners. The net gain from launching crowners, $14,000, needs to be compared against the net penalty from closing Rooks, $10,000. Since $14,000 gain is greater than the $10,000 effective cost of closing Rooks, the net effect of switching is positive plus $4,000, $14K, $10. In that very specific scenario where there's an immediate profitable alternative use for the resources, then we should cease Rooks and produce crowners instead. This just emphasizes that a shutdown decision is rarely made in a vacuum. It's almost always implicitly compared against the next best alternative use of the resources, which naturally brings opportunity cost into play.
Okay, that's really clear. Let's move to our second classic scenario, the make or buy dilemma. When should we produce a component or part internally using our own facilities, and when is it actually smarter to just purchase it from an external supplier? This feels like another purely relevant cost comparison.
It is. And when you're analyzing a make or buy decision, the very first thing you have to consider is the resource availability within your own operations. We essentially have two distinct scenarios that need two different analytical approaches. First, there's the simple scenario. We have unlimited capacity. What does that mean? It means our production facilities are currently sitting idle, or perhaps we have plenty of excess labor time and machine hours available that aren't being used for anything else profitable. If that's the case, the decision is usually pretty straightforward. We simply compare the internal incremental cost to make the component versus the external cost to buy it from the supplier. We choose whichever option is cheaper. Remember, only the incremental internal cost, the extra materials, the extra variable labor, the extra variable overheads incurred, because we make it irrelevant here. Any existing fixed costs are generally irrelevant unless, very unusually, making the item causes some specific fixed cost to be avoided, but that's rare in the unlimited capacity case.
Okay, that sounds simple enough. But the real complexity, and probably where the exam questions tend to focus, is the second scenario. We have limited capacity, meaning there is some kind of scarce resource involved.
Exactly. This is where we link back directly to that concept of limiting factors or bottlenecks we discussed earlier. If we are resource constrained, maybe we only have a limited number of machine hours available on a critical machine, or only 8,000 kilograms of a specific raw material, like in example 3. Then using that scarce resource to make component A might mean we don't have enough resource left to make component B. We therefore have to prioritize. We must decide which components provide the greatest benefit to the company from using up that precious scarce resource we possess.
And the crucial point here, I think, is that the correct priority isn't simply based on which component has the highest absolute dollar saving per unit, right? It's about the saving per unit of the constrained resource.
That is the absolute critical distinction. You've nailed it. We must concentrate on making the products or components internally that give the greatest saving. And that saving is defined as the difference between the external buy price and the internal variable cost to make, but calculated per unit of the scarce resource.
Okay, this sounds important enough to dedicate some proper time to. Let's walk through example 3 from the source material together. This involves that constraint of material B, where we only have 8,000 kilograms available, and we need this material to potentially make 3 different products, X, Y, and Z, which we could otherwise buy in.
Right, so the first step is always to determine the absolute saving per unit for each product if we make it instead of buying it. For product X, the variable cost to make is $10. The external buy price is $13, so the absolute saving is $3 per unit if we make X. For product Y, the variable cost to make is $12. The buy price is $17, so the absolute saving is $5 per unit if we make Y. For product Z, the variable cost to make is $14. The buy price is $16, so the absolute saving is $2 per unit if we make Z.
Okay, just looking at that intuitively, product Y looks like the best deal, doesn't it? It saves us $5 every single time we make it instead of buying it. But you're saying that simple comparison fails to account for the scarce resource, material B.
Exactly. That $5 saving is tempting, but it's potentially misleading if Y is greedy with the scarce material. Now we need to look at the consumption of the scarce resource, material B, for each product. Product X uses 3 kilograms of material B per unit. Product Y uses 2 kilograms of material B per unit. And product Z uses only 1 kilogram of material B per unit.
Right, so now we have to calculate the saving per kilogram of material B. We're essentially normalizing the benefit we get across the limited input, trying to find the most efficient use of each kilo.
Precisely. Let's do that calculation. For product X, it saves $3 per unit but uses 3 kilograms. So the saving is $3. 3 kilograms is $1 per kilograms of material B used. For product Z, it saves $2 per unit and uses only 1 kilograms. So the savings is 1 kilograms to $2 per kilograms of material B used. For product Y, it saves $5 per unit but uses 2 kilograms. So the saving is $5 to 2 kilograms, $2.50 per kilograms of material B used.
Wow, okay, the ranking has flipped quite dramatically. Product Y is still the best, $2.50 kilograms, but product Z, $2 kilograms, is now clearly better than product X, $1 kilograms, in terms of how efficiently it uses the scarce material B, even though Z's absolute saving per unit was the lowest. So the priority ranking for making must be Y first, then Z, then X.
That's the correct logical ranking based on the scarce resource. We must now prioritize making the products in exactly that order, Y, then Z, then X, until we completely exhaust our limited supply of 8,000 kilograms of material B. Whatever demand is left over after we run out of material, we'll have to satisfy by buying from the external supplier. So let's look at the demand for each product. Product Y, rank 1, requires 2,500 units. Since it uses 2 kilogranite, making all of Y would require 2,500 to 5,000 kilograms of material B. We have 8,000 kilograms available initially. 5,000 kilograms is less than 8,000 kilograms, so yes, we can and should make all 2,500 units of Y internally. Now, how much material B do we have left? 8,000 kilograms minus the 5,000 kilograms used for Y leaves us with 3,000 kilograms remaining.
Okay, 3,000 kilograms left. Next in the ranking is product Z, rank 2. The demand for Z is 4,000 units, and each unit of Z uses 1 kilograms of material.
Right, but we only have 3,000 kilograms of material B remaining. Since each unit of Z needs 1 kilogram, we can only make 3,000 units of Z internally before we run out of material. What about the remaining demand for Z? Demand was 4,000 units, we made 3,000, so the remaining 1,000 units of Z must be purchased externally from the supplier. At this point, we have now used up all 8,000 kilograms of material B, 5,000 for Y plus 3,000 for Z. The resource is fully utilized.
And that leaves product X, rank 3, which had the lowest saving per scarce resource. Demand for X was 2,000 units, since we have absolutely zero material B left.
All 2,000 units of X must be purchased externally. We simply don't have the scarce resource needed to make any of them internally, even though making them saves $3 per unit in absolute terms. And this represents the correct logical conclusion based on the constraint. By prioritizing making Y and Z first, we ensure that we maximize the overall economic saving generated from the efficient utilization of that limited 8,000 kilogram resource. The decision is never just about the cheapest variable cost in isolation when resources are scarce. It's always about maximizing the net benefit derived from the constrained resource itself.
That conceptual process, the ranking based on contribution or saving per unit of scarce resource, is absolutely essential. Okay, finally, let's move to what feels like the ultimate test of relevant costing, analyzing special orders using a comprehensive relevant cost schedule. This is where the accountant really has to bring all the rules together, sunk costs, incremental costs, opportunity costs simultaneously for one decision.
Yes. When you're faced with analyzing a potential one-off special order, the real challenge is adopting what the source material calls the practical mindset. It really requires meticulous, careful reading of all the notes provided in the question scenario. For every single potential cost element listed, you have to ask, what changes because of this specific order and what stays the same? You have to think beyond just pulling numbers off a standard cost card.
Okay, let's revisit example 2 again, the parser LTD contract, and maybe walk through 3 potentially challenging cost elements just to show how this practical, relevant costing mindset applies in detail. We already tackled the material cost earlier with the scrap value opportunity cost. But let's look at labor now, which is often complex because it can involve both fixed salary elements and variable or specific bonus elements.
Right. The labor scenario in example 2 involved a supervisor who must manage this special order if it's accepted. The initial quote seems to have included their full cost, listed as $11,500. This $11,500 was broken down into 2 parts. $8,000 representing a portion of their fixed annual salary, plus a specific $3,500 bonus promised only if this contract goes ahead. And there was an additional complication. By dedicating time to this special order, the supervisor would apparently lose out on earning $2,500 in regular incentive payments they would normally get from their usual work.
Okay, that's quite a few moving parts. Let's break down the 3 potential flows of money here using our relevant costing rules.
Okay. First, the $8,000 fixed salary portion. This is part of the supervisor's regular committed period cost. It's presumably unavoidable whether this contract happens or not. Therefore, irrelevant. We ignore the $8,000 salary allocation completely. Second, the $3,500 bonus. Is this relevant? Yes. It's clearly an incremental cost. It's a future cash outflow that will be incurred if and only if the decision is made to accept the contract. So the $3,500 bonus is relevant. Third, the $2,500 in lost incentive payments from their normal work. This is an opportunity cost to the supervisor, but what does it mean for the company? It means the company is actually saving $2,500 in incentive payments it would otherwise have had to make if the supervisor was doing their regular job. So this $2,500 represents a relevant saving to the company's cash flow resulting from the decision.
Right. So for the supervisor's involvement, we have an incremental cost, the bonus of $3,500 going out, but we also have a relevant saving, the foregone incentive of $2,500 coming back in effectively.
Exactly, which leaves a net extra cost to the company for the supervisor's time of only $1,000. $3,500 extra bonus payment minus $2,500 saved incentive payment. This $1,000 is the only relevant cost figure relating to the supervisor's salary compensation for this decision. That's a massive difference from the initial vague estimate of $11,500, isn't it? This really shows the power of relevant costing. It strips away $10,500 of irrelevant committed costs and focuses purely on the marginal impact.
That requires some serious conceptual clarity to get right. Okay, let's move on to overheads and depreciation, another area that often causes confusion. The accountant in the example initially included an apportionment of $3,000 for general fixed overheads, plus they added an estimate of $1,000 for incremental overheads specific to the job.
Right. Let's apply the rules. That standard fixed overhead apportionment, the $3,000 figure, that's typically the company trying to allocate its general, unavoidable fixed costs like factory rent, head office admin, across all jobs, using some predetermined rate. But ask the question, does taking this one special order actually change the company's total fixed overhead bill for the period? Almost certainly not. Therefore, that $3,000 apportionment is irrelevant, as it doesn't represent an extra cash flow caused by this decision. We ignore it. We only include the $1,000 estimate of incremental overheads. These would be extra, variable-like overheads directly caused by the special order. Maybe things like extra power consumption for the machines or specialized cleaning fluids required just for this job. If it's an extra cost incurred because of the order, it's relevant.
And presumably the same logic applies to standard depreciation figures included in costs, like the $4,500 noted for the machinery used on the job.
Yes, exactly the same logic. Normal, straight-line depreciation calculated for financial accounting purposes is irrelevant for decision-making. Why? Because it's a non-cash charge. It's simply an accounting mechanism for allocating a sunk historical cost, the original purchase price of the machine, over its useful life. The cash already left the business, probably years ago when the machine was bought. However, looking closely at the notes for example 2, the source material specifically mentions $500 in additional machine maintenance costs that are expected to be incurred because of the heavy use required by this specific special order. Now, that $500, that represents an extra future cash expense that is directly caused by the decision to take the order. Therefore, that $500 maintenance cost is relevant and should be included.
This really demonstrates that essential rule again. Ignore any non-cash charges that are just accounting mechanisms for spreading past spending. Look only for new cash outflows happening because of the decision, or as we saw earlier, lost cash inflows.
Yeah.
Opportunity costs.
And finally, just to complete the picture from example 2, let's consider the finance costs. The scenario mentioned that taking on this special order would require the business to arrange an incremental bank overdraft facility of $20,000, specifically for the 3 months the project runs, and this overdraft would incur interest at an 18% annual rate.
Okay, so since this extra debt and the interest payments associated with it are future cash flows that only arise because the company chooses to accept the special order, they wouldn't exist. Otherwise, they must be relevant to the decision, right?
Absolutely. They perfectly fit the definition of a relevant cost. Future cash flow differs between alternatives.
Really?
The simple interest charge for the 3-month period needs to be calculated. That would be 18% per year on $20,000, but only for 1 quarter, 3 months of the year. So 18%, $20,000, 312 equal $900. This $900 interest payment is a direct incremental financial cost of undertaking the project and absolutely must be included in the relevant cost schedule when determining the true minimum price the company needs to charge to break even or make a profit on this specific order.
Looking back at the total picture for that example, too, you can really see the power of applying this method consistently. The total relevant cost calculated for the special order dropped dramatically, didn't it? From an initial, possibly standard cost-based estimate of around $98,300 down to a final relevant cost figure of $88,200 after applying all these conceptual filters correctly. That massive reduction just shows how relevant costing accurately identifies the true economic floor price needed to ensure the contract is genuinely profitable for the firm, because it focuses only on the true extra economic cost incurred.
It really is the difference between potentially making an unprofitable decision based on flawed historical or allocated data and making an economically sound decision based purely on the marginal impact of that specific choice.
We've definitely covered a tremendous amount of ground there, moving from the abstract definitions right through to concrete application in those 3 core scenarios. I think the crucial takeaway for any learner listening is that management accounting decisions, especially short-term ones, they aren't really about perfecting historical figures for external reporting. They are fundamentally about understanding the economic impact of change to help with internal decision-making.
Absolutely. And to perhaps crystallize this mindset shift, maybe we can distill everything we've discussed down into 4 essential questions, like a conceptual checklist, that you should try and ask yourself for any short-term decision problem you encounter, whether it's a shutdown, a make or buy, or a special order.
Okay, a checklist sounds useful. Let's start with the past. Question number 1 should be, is this cost something that has already been incurred, or is it a sunk cost?
Right. And if the answer to that question is yes, then your immediate response must be, ignore it. It is irrelevant to the future decision. Just strike it out mentally.
Okay, step 1, eliminate the past. Now, moving to the future. Question number 2, is the cost item we're considering a future cost? Will it occur after the decision point?
Yes. If the answer is yes, it passes the first real barrier and we proceed. If it's not a future cost, like depreciation on past expenditure, it cannot possibly be relevant to a future decision.
Got it. Future cost confirmed. Now the comparison element. Question number 3. Does this future cost differ between the options we're considering? Would this specific cost be incurred if we choose option A, but not if we choose option B, or vice versa?
Exactly. If the answer here is yes, the cost changes depending on the path taken, then it is a relevant cash flow for the decision. It'll either be an incremental cost, a new outflow caused by one option, or perhaps an avoidable cost, a relevant saving if we choose the option that avoids it.
And finally, probably the most subtle but critical question, the one that captures the hidden impacts. Question number 4. Is there an opportunity cost involved? By choosing in this particular path, are we sacrificing a contribution or a saving or some other benefit that we could have obtained from the next best alternative use of our resources?
Yes, and if the answer to that question is yes, you absolutely must include that sacrifice benefit as a relevant cost of the option you're evaluating. This forces the decision maker to always factor in the true, full economic consequence of their choice, including what they're giving up. If you mentally run through that 4-point checklist every single time you face one of these problems, is it sunk? Is it future? Does it differ? Is there an opportunity cost? You will stand a very, very good chance of correctly identifying the relevant financial information needed to drive the decision, regardless of how complex the scenario might seem at first glance.
Mastering this conceptual approach really does feel like the prerequisite for success in well, much of the rest of the performance management syllabus, doesn't it? You absolutely need to know your true marginal relevant costs before you can start layering on more complex analyses.
Couldn't agree more. From this foundation, we naturally move into more advanced topics like dealing with risk and uncertainty in decision-making. We've spent time in other deep dives discussing things like probability models, decision trees, calculating expected values, which usually features in the chapter following this one in most study materials. But the point is, you simply cannot start analyzing those complex probability distributions or building those decision trees until you are absolutely certain that the payoff figures you are plugging into them, the potential profits and losses under each different scenario or state of nature, are themselves based on correctly identified relevant costs and revenues. If you get the cost base wrong at this stage, for instance, if you accidentally include a big sunk cost in your calculation, or you completely forget to factor in a significant opportunity cost, then even the most sophisticated risk analysis technique in the world will inevitably lead you to a guaranteed bad decision. This relevant costing foundation is truly non-negotiable.
And that's our deep dive into short-term decision-making. Really all about focusing on what truly matters in the immediate future, making that crucial conceptual leap from just reporting historical accounting numbers to genuinely informing forward-looking management decisions. We really hope this helped you simplify the underlying logic behind these foundational performance management questions and perhaps give you a clear conceptual checklist to use for every problem you face going forward.